The final budget before Brexit is a once-in-a-lifetime opportunity to sell the United Kingdom as this vibrant, swashbuckling, international free-trading economy. Surely the chance to invoke radical supply-side reforms, to cut corporation tax and VAT, to become the Singapore of the West. Well, no. That didn't happen, did it? And actually, paradoxically, I think in these last few months before Brexit, my view is that Fiscal Phil has probably made no deal more likely. I take the view that yesterday he could have taken the opportunity to flash a bit of ankle at the EU. He could have said what he would have done in the case of a no deal. And if he'd talked about a few of those things, I think they would have sat up a little bit. He didn't, so I don't think they will. Instead, he talked about potholes, and he referred to numbers that, frankly, will be probably lost in rounding. So with the limited content that Jason has already referred to, it's always useful, I think, to return to first principles. Budgets continue to be intensely political affairs, and that's what we saw yesterday. And what is politics if not the power to be able to control our money and our lives? I've summarised that as these two levers through which that they can achieve this: levying taxes and printing money. Now, I have some colleagues following me who are far better qualified to talk about taxes than I am. But I think it's always worth recapping just how taxed we are as a country already. The tax burden is at a 49-year high, 34% of GDP, the highest since 1969. Fiscal Phil in the past has described himself as a man of sound money. And I thought at some points yesterday he seemed a bit narked that the Prime Minister had kind of pulled the rabbit out of the hat for him around the NHS spending. Yesterday he needed to end austerity, but he needed to do it in such a way that he couldn't have been blamed for having had austerity for so many years. He needed to put political water between himself and John McDonnell, so he couldn't raise any of the big name taxes or borrow more money. So 23 taxes we have in all. Since the 70s and 80s, privatisation has reduced overall government receipts. So the government receipts aren't all taxes, but it's worth noting that this end to austerity that was announced yesterday essentially sees government expenditure at 2007 levels. So you see the graph at the end there, the green graph. We're going back to levels at the time of Tony Blair, who was hardly a notorious belt tightener when it came to spending. So I would question if the last few years have really been austerity in an economic sense. Yes, if you look at it in terms of the debt and the interest burden, and we'll talk a little bit about that later. Overall, tax receipts are the highest they've been since 1986. Tax burden, the highest it's been since 1969. And we were looking at the March OBR numbers because we were preparing quite late in the day for this. And they had government spending for 18-19 at £813 billion and government receipts at £776 billion. That's the 37 billion deficit prior to the budget. I'll come back to that number shortly. One of the things you hear, I think, ad nauseum from the business lobbying groups, the IOD, the Chamber of Commerce, the FSB, the Bank of England, the European Union, is this refrain that business hates uncertainty. I find this expression a little bit tiresome and a little bit trite, not least because I think it misunderstands good business. Good business eats a full English breakfast of uncertainty every day. There are productive businesses in our economy that thrive on uncertainty. And it's my view that sort of capitalism and business, by definition, is a creative, disruptive and uncertain process. So just going back to what I said earlier, and this announcement of maybe turning the spring statement next year into a full budget in the case of no deal, I think Fiscal Phil's got the tactics a bit wrong here. By not contemplating a no deal yesterday, I think he's put himself in a position where it's almost a signal to the EU that perhaps he's not serious about it. So why would they concede ground? And paradoxically, I think that makes a no deal more likely. So remember that you heard that here first. So putting all these things together, slow growth or sluggish growth, though it's worth pointing out that it's growth ahead of where France and Germany is at the moment. Decent employment figures, already high tax burden, Brexit on the horizon, and an instinct to balance the books, which Phil could have done, means that in continuing to spend and to incur this 26 billion deficit down from my 37 billion is quite a big thing politically for him, quite a big thing psychologically, if not big in absolute terms. 26 billion is 1% of GDP. And I sort of, having done these events a few times now, I do have a little bit of skepticism about OBR forecasts. I think any economic model that can't accurately model 7 billion individuals who are buying and selling in markets all over the world is inevitably going to be wrong. And we've seen that again with the OBR growth forecast being revisited. Austerity then. Language is a very powerful thing, isn't it? To me, this word austerity sort of conjures up images of Dickensian Oliver Twist workhouses. I don't think it is real in a Dickensian or economic sense, what I said about the tax burden and the spending earlier. But I do think it's alive and kicking, as we're seeing, in a very political sense. It's a motive, and it's a reminder, really, of just how much money we spent on bailing out the banks. Remember, back in 2008, the banks played with other people's money, which has become our money as taxpayers. And one of my favorite facts is around the United States and what the US spent in real terms in the 2008 bailout. More than the Marshall Plan, the Louisiana Purchase, the Race to the Moon, the Savings and Loan Crisis, the Korean War, the New Deal, the invasion of Iraq, the Vietnam War, and NASA combined was spent in bailing out the US banks. That's true, and that, my friends, is printing money. So those of you that know me know that this is one of my favorite graphs. The base rate, 250 years, we had steady money. Something happened in 1971. There's something called Bretton Woods, Richard Nixon, and dropping of the gold standard happened around that time. And since then, we've had a lot more volatility. If we focus on more recent years, what you can see on this chart that plots base rate and CPI, you see real terms, negative interest rates in the last 10 years. Yet still we'll refer to these as emergency low interest rates. It's politically expedient, isn't it, to kick the can down the road, and that's what we're seeing in a much smaller way with the Brexit negotiations. It's history repeating itself, yet in the case of Brexit, we have this date, the 29th of March next year, by which time something has to be done. Hence my feeling that we may well not have a deal. Now, as we know, economies are based on confidence, and whatever you might think of these two characters, and it's easy to knock individuals, what about the economic facts? Well, we can see from the world that whilst Europe is putting taxes up, America is lowering them and raising interest rates. We're seeing a shift of capital moving from Europe to the United States. What's happening now? You wake up every morning, you see news about the FTSE. Nobody talks about the bond market, yet the bond market dwarfs the stock market. The stock market's just a souk where stuff happens based on hearsay. The bond market is real money, and we're seeing a number of big global trends internationally. A lack of confidence in government across the world has had an impact on bonds and interest rates, and even in this country you're seeing a ticking up of bond rates as people decide they don't want to lend the government money. They ask for more interest. And we're already seeing that in great terms in places like Turkey, Argentina, and South Africa. Another factor is London house prices. They've come down considerably at the top end, 15% in some cases, which is pretty big when houses are worth millions. Possibly people are fearful of Mr. Corbyn and a change of government. Possibly it's people voting in terms of their confidence in government. So we're seeing this sort of economic evidence of what I remember as Gresham's law. I don't know if anybody knows about this principle of bad money driving out good. It's an old-fashioned principle of when currencies were coins and they were literally debased. What we're seeing is smart money on the move. My favourite illustration of that, if you'll allow me to be flippant, is I grew up in the northeast of England, and whenever my dad got one of these in his wallet, he tried to spend it as quickly as he could. I don't know why, but it just seemed to be slightly irrational. That's legal tender. But it was a case of Gresham's law, and that's what we're seeing with money leaving the UK and leaving certain good parts of the economy and being replaced by bad money. Quite interesting for me because what we are seeing in my world is possibly the topping out of corporate valuations. Possibly, I've written about this in the last year, possibly a good time to be thinking about selling your business, and possibly, I think, a no deal in the long term. But what's the long term? Maynard Keynes, who many would see as the father of anti-austerity measures, would always say that in the long run, we are all dead. I don't know what he would make of the current economic situation, but I will leave you with that quote, and I will hand over to my colleague, Graham Doubtfire, who's going to go into a bit more detail about personal tax. Thank you for your attention.